Hi, good morning and welcome. It's Monday, 17th of December 2018. This is Real-Time Daily Trading Ideas, our global webinar series. We have 5 days a week, 5 different traders. We will speak about trading ideas, strategies, market screening, maybe 1 or 2 questions from your side directly answered in our webinar. Our goal is quick and smart, so let's have a nice start like every day. And like every day, we will start with our disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk, which is not suitable for all investors due to their complex nature. If you are a starter, please start with a demo account and make yourself familiar with long trading, short trading, leverage trading, and your personal risk management. If you'd like to read the full disclaimer, just visit one of our regional web pages, for example, admiralmarkets.com, and you will find the long version there. If you're in the European Union, you will also find some information about the different offers and options for retail clients and professional clients. One of the topic of the years for all European CFD traders. A picture shows more than 1,000 words. The margin requirements could be quite different. DAX 30 and Euro-Dollar, 2 prominent examples. If you're a professional trader and you like to get the professional client status, you can apply for it online if you're eligible. Retail clients still have a big benefit. It's called unlimited protection against negative balances, what professional clients don't get via regulation. But some brokers and of course also Admiral Markets have some additional to offer. It's called negative balance protection policy. And via that policy, also professional clients get a protection up to 50,000 British pounds, what is round about 70,000 euro. All details and how to apply for it via that link, what is displayed right now. This is me. My name is Jens. My English made in Germany. So Admiral Markets have big international Forex and CFD brokers. We have over 18 country offices. Check it out on our web pages if you like to. And this is our scheme. On Monday, like today, it's Jay's Day. On Tuesday, it's Paul's Day. On Wednesday, it's Giancarlo's Day. On Thursday, it's Marco's Day. And on Friday, it's Dirk's Day. Our leading day traders live every business day, every trading day to the same time. And of course, if you like to trade Forex and CFD, so we get many benefits only with us. For example, DAX 30, also Euro-Dollar, typical spread of just 0.8 points or pips during main trading hours without additional commission. This is a little bit outdated because since 3 or 4 weeks, we have even for Euro-Dollar and our Forex majors a better spread. So actual is Euro-Dollar 0.6 pips only. So we're getting better since a couple of weeks. Check it out on admiralmarkets.com. Same like you can check all our global offers. We have an office in Chile, we have an office in Australia, and of course also in the European Union. If you'd like to read more about it, just visit our web pages like admiralmarkets.com. Enough from my side. Now it's time for Jay. Good morning. Good day, Jay. What's your view to the markets today?
Hey, good morning, Jens. Good morning, traders. I hope you're doing well. Hope you're enjoying the pre-Christmas season. Let's see, which screen am I showing? How I enjoy technology in the morning. All right, excellent. Let's see what you guys can actually see. Okay, the risk disclaimer. Excellent. Hey, good morning, guys. We're missing some traders. What's up? Are you guys Christmas shopping? I hope so. Don't get stressed over Christmas. A lot of people get all upset. This is the last week of serious trading. Jens, I need to get in touch with you because of Monday when we start business again. I might still be out, but I'll send you an email on that. Trade last week, we were looking to long the euro pound. We had a very good webinar, and my hope was that we would retrace back to the role reversal around the 89.30 level and then hit our target around the 90 level and or beyond. And what happened is that you would have been able to make some pips. One inclination that it may not retrace was the volume, guys. Please learn how to trade volume and what price does. So we didn't have an official trigger, but we did have the opportunity to make some money. We hit into the level, and the level 90, the figure, had some liquidity. And then always the question is, what do they, the market participants, do with that liquidity? And as you can see in this case, they used to buy the liquidity and hit the second level beyond. So we hit the second level of liquidity as well. We were rejected there. We came back. The initial level, our first target, acted as what we call a role reversal. And then the market was aiming to get the stops above the second level of liquidity, that swing high. We didn't reach it. We call that a failed auction. It's a strong inclination that we're heading down. We did head down. We hit into that level. We came back lower. So right back to where we almost started the whole journey, and we're holding at that level. Now the market is waiting for new information. It is so messy, the Brexit situation. It is so unbelievably messy. I prepared a slide on that, the market is currently in a wait and see position. So this week's trade obviously will not involve the euro or the pound. It is just too crappy. It's nothing to be involved in right now, except if you are a day trader, we get new information and you're able to hit the button real quick and you actually know what the hell is going on. Headlines for this morning. So hopefully some of you made some pips on that trade. We do have a little bit of a subdued risk on sentiment. I'm saying subdued because on Friday, Wall Street closed really weak. All three majors around 2% down. My initial expectation for a year-end rally went to crap. There is no year-end rally. And I had a deep in the money bull call spread on Amazon, which I closed down for over 20% profit. But that was the final trade on my side in equities for that year, for this year. I closed down the book and I'm waiting for next year. I'll say a few sentences about that in a second. What did we see in Asia, guys? We saw Australia on the back of material and mining actually close a little bit green with plus 1%. Why? Ministry of Finance in China actually announced that they're suspending retaliatory tariffs on US vehicles and auto parts for 3 months starting January 1st. And initially the tariffs were supposed to be 40%. And they lowered them back down to 15%. So it's a little bit of a sign towards a relaxation in terms of the trade war. Excuse my voice, it's still not 100%. I'm still a little bit sick. But the problem is Trump and his goddamn tweets, excuse me for cursing. I mean, it's just, if this guy could just stop this stupid ass trade war, it'd be so great. The year-end rally would be there, but could have, should have, would have. He doesn't even know what he's going to tweet in the next minute. So he single-handedly started the trade war. He single-handedly may or may not stop it because he probably doesn't even know what he wants or needs from one moment to the next. I'm very, very sad to see Marine Corps General Kelly leave as Chief of Staff. He's gone. He's out the door. One seriously good guy has left the administration. I'm extremely, extremely pessimistic now. And the Chinese, if you don't know this, they think in centuries, okay? That's why they're the #1 power to be. They think in centuries. And the Americans think in 2-year terms. So Democrats have the House back. Trump will not be able to push through any meaningful administration without the Democrats on his side. There won't be a lockdown. There's going to be some hassle about increasing the debt ceiling once more, as every year. It's going to go through. There's no wall to be built right now. Basically, I don't expect very much out of the US. And for an economy that grows at 2.8%, earnings multiples came off almost 30% in equities, and the market is down. That's a bad sign, guys. It's just a bad sign. There should have been, under any normal circumstances, a year-end rally, and we're not seeing that. Anywho, weaker yen, so Nikkei was up, Shanghai and Hang Seng unchanged. Industrials were weaker because industrial production numbers came in weaker. Housing numbers came in better, so there was some support for equities in that regard. Out of Japan, that was interesting. 10-year yields, JGB's 5 months highs. Why? Because we had some, not the yields, the price. The yields at a 5-month low on the fears of slower global growth. And we have 3 central banks this week, and you guys can expect, we all can expect every single one, every single central bank to mention this in their communique this week. Slower global growth because of the trade war. Trump thinks he's winning. He doesn't understand the Chinese. They're just going to sit tight for another 2 years, and that's that. He'll be gone, or he'll be voted back in, and then they'll just wait for another 6 years. They don't care. Brexit. Rumors of a second referendum hit the tapes. Then UK Attorney General supposedly told cabinet ministers that May needs to be removed after the 29 Brexit, March 29, that is, excuse me, guys, so that others could renegotiate her deal. May, on the other hand, secured enough support to survive the no confidence vote. She'll be safe for another 12 months now. We had 11 cabinet members in favor of a managed no-deal Brexit. We have May's approval rating by 1 poll coming in the highest ever with 47%. We have the EC publishing an action plan on Wednesday for a no-deal Brexit situation. It is so messy, highly difficult to trade at this point. That's why liquidity is drained. A lot of market makers do not provide liquidity in the pound currently. Last week before the holidays, stay away or be very quick when you have momentum scalps based on a headline. Italian government situation. Looks like they're adjusting fire so that the European Union will not start punishment procedures to the deficit GDP target to around 2.04%. Italian government thinks that's affordable. Spread Italy 10-year versus Germany 10-year is coming in. So it looks like that's getting resolved right now. The market is pricing in a resolution. But, and that's interesting, France's yellow jackets are costing the economy GDP growth, actual growth, and so the deficit for 2019 is likely to reach 3.2%. So rightfully so, the Italians are saying, hey guys, what are you looking at us for with 2.4%, which we think we can get, and now we're offering 2.04. Why is nobody talking about France? And everybody's talking about France. So focus is shifting now towards France. And if you don't know that, guys, 3% is the ceiling. Yeah, you're not allowed to exceed 3%. So that's going to be interesting. What is the European Union doing with the French breaking the ceiling of 3%? Aussie Treasury downgraded 2018-19 GDP forecast by 25 basis points. Amazing. And what did the Aussie dollar do? Not much. So that's bad for Australian economy. So forget the Aussie long. And then on the Kiwi side, we saw weaker services PMI coming in at 53.5 versus 55.4 last, and the Kiwi reacted accordingly and actually sold off. Dollar yen around 113.5. My traders this morning in our WhatsApp group already discussed this because we have a couple of chief financial officers from larger companies in our team. And Hitachi purchased 80% of Sweden's ABB's power grid for $11 billion. So Hitachi selling yen, buying US dollars to get that transaction done. So that's what I keep saying. In the end of the day, almost everything that happens around the globe, we meet in the Forex market. It's super crucial to know about these large deals if and when they get through the market because they'll actually push markets around. 11 yards, i.e. $11 billion, is quite a lot of liquidity. This morning, ABB stock opened up 2.5% positive, and naturally, this transaction is hitting dollar yen as a pair. Here's the spread, Italy 10-year versus Germany 10-year at 2.664. We're coming off the highs. It looks like the market's starting to pricing in a resolution as said. Messy picture this morning, not much liquidity, not much going on. The dollar index around 97.60 area, holding above 97.5. What we can see here is the New Zealand dollar on weaker numbers initially coming off, and now being manipulated higher. Yes, you heard me correct. Pound recovering a little bit, and we're seeing the Aussie dollar coming off a little bit. Not very much reaction based on the Treasury's downgrade of the GDP growth number. That was a little bit surprising to me. We'll see how that develops this week. In the interest of time, I'll skip the live one, and we'll go right into the slides. If we have some time, we'll go through live data afterwards. All right, week ahead, central bank review. What do we have? We have FOMC this week. Excellent, 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 because that means we can make some money. Here's a graph of the federal funds rate currently. Market is pricing in a 78.4% probability based on Fed fund futures that the Fed is raising rates by 25 basis points to a new bandwidth of 2.25 to 2.5. Now, I'd be interested to know, and I know my traders know this, if any of the non-J traders know what the actual terminal rate is by the Fed. What did the Fed communicate to us by year-end 2019? What their terminal interest rate band will be? Do you know? Anyone? Nigel, do you know? Good morning to you. Darshan, do you know? Okay. Nobody's typing anything. So in the interest of time, I'll go on. Focus will be on projected 29 trajectory of rate hikes because the Fed is shifting from a hiking cycle into a data dependency. And currently we only have 15% probability for 2 more hikes by year end 2019. So in the last September staff economic projections, they are looking at federal fund rate year end 2019 target, the Fed itself, by 3 to 3.25, 3 to 3.25, and the market is pricing in 275 area. Yeah. Big discrepancy, and it's going to be very interesting. Morgan Stanley already published a research paper where they said the median dot plots will probably stay the same, but the tails, i.e., what are we seeing in terms of 3.25, that's going to come up, and that is going to be lowered. That is probably going to come in a little bit. So this is our trading opportunity. The trading opportunity is if and when the Fed actually adjusts down towards the market, then we'll see some dollar weakness, and that can give us a whole host of trading opportunities. Think of emerging markets, for example. Yeah, think of what's been really weak there. If we can long any of the currencies there that are suffering from the dollar, from the recent dollar strength. So we see a difference in terms of what the market is pricing in terms of what the Fed has communicated last. And this is based on tighter financial conditions, i.e. the Fed raising the rates, but also by reducing the balance sheet. By the Fed not being the buyer of marginal debt and not reinvesting all of the money that is actually coming back from debt getting paid down by the Treasury, and the money is hitting the SOMA account, S-O-M-A, the SOMA account of the Fed, that money is actually being taken out of the system. So that's what we say is called tighter financial conditions. And the trade war is causing a slowing global growth. And that is why the market is saying, dear Fed, no way can you hit 3 to 3.25. We think you're going to come in lower. It's crucial that you understand that. If you don't understand that, if you're still at the point where you're looking at charts to give you a trade idea, please stop doing that. The big boys are not trading that way. It's the fundamental drivers that determine where you should be long or short. And then you go into the charts to fine-tune your entry and exits. Then we need to watch for the language, because so far they've always used the two words further gradual rate hikes. And we're expecting that to be tweaked towards some wording that will imply data dependency. This goes out to my guy Hendrik. Hopefully he'll keep an eye on that for us, because he does the central bank watch. And then this is what I alluded to early on in the opening statements this morning. The price earnings multiples in the US fell from 20 times to 14.5 times. And half of the individual stocks of the S&P 500 are officially in bear market. Bear market means off the top, down 20%. So the index itself is not in bear market, but half of its members are in bear market. The FANGs, i.e. the tech, the handful of tech names that drove this, like Apple, Netflix, Google, that drove this rally over the last few years, and especially the last inning of these few years, those names are down 30 to 60%. I even closed out my Amazon bullish trade, which was super safe, and I could have tweaked out the last percentages in terms of profit, but I didn't, because it looks so shitty. The picture looks so bad. Trust me, based on all of my years of experience, we should have seen a massive Santa Claus rally, given that year-on-year GDP growth is around about 2.8%. Unemployment is at 50-year lows, and earnings are growing at 26% year over year. And the market is not reacting. So the equity indices are a future economic indicator, okay? We're pricing in a future scenario that's 6 to 18 months in the future, roughly. Equity indices are signaling to us recession is ahead. And in the next couple of years, we have an over 50% probability priced into the market right now for a recession in the US. And think of this, if Trump can get like a tax deal 2.0 through, that's going to be very, very bearish. Okay, I need to hurry up a little bit. I think I'm wasting time. I'm just trying to get across to you how dismal this current situation is. Pound and Brexit may survive no confidence vote. Hence, she is now immune for another 12 months. 170 votes against her pretty much means that her deal will not pass Parliament as is. Last week, if you haven't watched last week, Please go through the scenarios provided to us by HSBC of what can happen if Brexit deal passes, doesn't pass in a different manner, fashion, adjustments, blah, blah, blah. We gave targets, upside targets and downside targets for cable. I didn't want to duplicate this in this week's meeting. If you haven't watched last week's meeting, everything is still valid based on HSBC scenario analysis. January 21st is a deadline for the vote. January 21st. Potentially May is running out the clock. That's from my playing US football. We used to use the strategy if we were ahead and we just run out the clock until game time is over. And it looks like that's her strategy right now towards March 29, because she wants to force lawmakers to come around towards her deal, which may then look better than no deal. And the Bank of England was very pessimistic what may happen in a no deal scenario. Speaking of which, we have Bank of England on Thursday. They're expected to keep rates unchanged at 75 basis points with a voting of 009. So the first number means how many members voted to increase the rates, the second means how many voted to decrease, and how many members vote to hold rates unchanged. The Bank of England caught a lot of flack and fire for their analysis of a no-deal Brexit. Market participants said the BOE was politically motivated, and they caught a lot of shit basically. Because they said in a no-deal Brexit scenario, they expect the UK economy to contract by 8%. That is huge. That is gigantic. That is so scary. And house prices may fall by nearly 1/3. So the wealth effect would be dismal, okay? The FTSE would come off, hitting the so-called wealth effect. House prices come off, hitting the so-called wealth effect. It would be a nightmare. Current environment. What is the current environment? We do have political uncertainty. We have a 20% plus fall in sterling oil prices, which the largest members of the FTSE 100 are oil-related companies. And we have a slowdown in business activity. Sentiment, consumer and business sentiment is dropping. Numbers last week were bad. So this uncertainty is not playing out well for the Bank of England. Now, the data. How can the Bank of England raise by 25 basis points for the next 3 years per year as they communicated to the market if the data is deteriorating? I don't see it. I do not see it. So sterling long, difficult at the moment. Market expects the next rate hike in the second quarter of 2020. Write that down. If that changes, the sterling will change accordingly, okay? Your job as a Forex trader is to always know when the market is pricing in the next hike or the next decrease in rates. That is your job. As a Forex trader, basically you are a rates trader. Thank you. Wednesday, we have CPI numbers. CPI, Consumer Price Index, basically means inflation. 2.3 versus 2.4. Why? Lower oil prices, naturally. Thursday, retail sales, a little bit better. Difficult. All the economic think tanks are saying the models are difficult to price this time because Black Friday, yada, 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 none of our concern. Friday, final third quarter GDP Q and Q 0.6 versus 0.6, year-on-year 0.5. So here, look at the numbers. UK retail sales. Very mixed picture. Look at UK inflation rate coming off. Okay. It's difficult right now. It's very difficult to price the pound. I have one of my traders asked me this morning, long, short, he's more bullish. I'm completely neutral right now because the uncertainty and the liquidity is so bad that there is no clear direction. If this somehow muddles through, we could see some strength. If they completely mess this up, we could see some serious weakness. Okay. So if at all, you need to keep extreme points on the radar, decision points we call them, and see how price reacts there in accordance with volume and trade accordingly. All right, Bank of Japan, snooze fest. Thursday expected to remain at negative 10 basis points, and the 10-year yield, they call that yield curve control, at nil. Summary of opinions for October. What did they tell us? Necessary for us to persistently continue with powerful monetary easing will take time to reach inflation target of 2%. Hey, we've only been doing this shit for 27 years. It'll take a little bit more time. Okay, of course, fine. We're happy to wait. Kuroda pushed back when this target will be reached from 2020 to fiscal year 21. Of course, it's going to take however long it's going to take, if it's ever going to get there, ever. Okay, they've printed so much money and it's not really helping inflation. Nothing new over in Japan. Focus will be on global growth concerns due to trade war, Brexit, and fiscal and political uncertainty, especially in Europe, sorry. Recent data, GDP was revised deeper into a contraction, negative 60 basis points versus expected negative 50. The Tankan survey was mixed, and consensus is for a dovish meeting. If you're listening to this, you don't know what the Tankan survey is, Google will help you. Google it, learn it, watch it, trade it. Consensus is for a dovish meeting. So selling top edges in the yen is a possibility this week. Potential trades, because I'm looking at the time. Yep, 27 minutes. Sorry, Jens, I'll hurry up. Potential trade this week. Shorting New Zealand versus Canadian dollars. I want to stay away from all of the rate statements this week. And I'm observing that in New Zealand, we're getting weaker data. On the other hand, I'm observing that, here's the weaker data argument, that I'm seeing mixed to stronger data in Canada, high correlation to the US economy, which is doing okay-ish, or okay still, and I'm seeing and observing a potential bottom in oil. The 50 seems to be holding. Seems to be holding. It's definitely a decision point, so we'll have to see. End of the week, last week, some weakness crept into the oil market because there's more supply coming in. The cut that was supposedly decided by OPEC may not be coming in as high and as significant as they decided. I think they decided on it was 1.2 million barrels. So more supply means lower oil prices. Not an easy no-brainer trade, but the risk to the trade is not that the numbers are coming in different than expected and or oil prices keep tanking. If they hold or recover, you'll see a stronger Canadian dollar. And if we do have some numbers coming up in New Zealand for this week that are expected to come in weaker, so you want to sell, if at all, sell top edges in New Zealand versus Canadian dollar. Here's a chart. Happy to short around now. If I see the correct price volume reaction, we are hitting liquidity right now. We are doing what we call a square up. We are at a roll reversal, pulled the trigger. And or wait until we get towards 91.40. Target for both trades is around the 90.50 and stop losses are about half the distance of what we're expecting to make. I like the second trade better. You might, if you wanted to agree with me, you might want to go ahead and split your risk. If you're risking 1%, risk 0.5% now and risk 0.5% later. That concludes the final morning meeting at Admiral Markets by J. Medro Forex Trading Seminars. I thank all of you for this year. We've had a significantly positive run into the year end. We did some great trades. It is absolutely possible to come up on a Monday morning with trades for the week. I thank you for your participation. I thank you for your passion for our profession. I thank you that you're putting in the time and effort to learn what professionals are doing. And I thank Jens wholeheartedly for the opportunity to teach retail traders what and how the markets actually work in a professional sense. So my gratitude to you guys. Thank you for your questions. Thank you for your loyalty. Thank you for your passion. And let's enjoy the holidays. Healthy, happy new year to you. And next year we'll make some serious money. This is great. Our motto is trade smart, live free, and one team, one dream. In that sense, thanks for joining. Have a happy new year. Merry Christmas. Love you. Speak to you next year. Bye-bye.
And our motto is 5 days a week, 5 different traders. So tomorrow is another day. If you'd like to see and watch another trader, just visit us tomorrow, same time. This week, last Christmas week, we have every day a webinar, and then we have a small holiday, and we will start 2019 again. Thanks to Jay, thanks to all of you. And if you'd like to see and watch that again in a couple of hours, it will be available on our YouTube channel. Just go to youtube.com/AdmiralMarketsFX. Greetings from Berlin office. Bye-bye.